All right. Well, welcome back, everyone. We're sitting here in January of 2025, ready to talk about all things markets and the economy. We have some kind of like breaking news coming in right now that just happened yesterday as we record this. So we're excited to talk about some of the pieces that happened around AI and how that impacted tech stocks and chip makers in particular. So really good conversation. Looking forward to it today. And then let me get to our next slide here. All right. So, introductions for those of you who are joining us for the first time. I'm Jared Music. I'm the CEO here at Destiny Capital Entrepreneur Aligned. I work closely with Tim Doyle as a thought partner, thinking through what we're seeing in terms of data and information and what that should tell us to do in terms of allocation of investment dollars for clients and sort of trying to look into the future and see what's coming down the road. Tim?
Yep, my name is Tim Doyle. I'm the Chief Investment Officer here at Destiny Capital. I manage our investment committee, which is in charge of things like portfolio construction, asset class research, investment manager due diligence, and much, much more. But we've got a lot of interesting stuff to talk about this month, so I'm excited to get into it.
Awesome. Well, before we dive in, we do have to go through our disclosures and caveats and all of those things. So please, we are putting on this webinar as an educational piece. It's designed to be as accurate as we can possibly make it. It's possible that we've made errors in some of the stuff we're going to say, charts, graphs, et cetera, et cetera. So please do not make any irreversible decisions without talking with your Destiny Capital team if you already work with us, or your wealth advisor who's outside of Destiny Capital if you don't work with us. Similarly, talk with your CPA, tax advisor, attorney, anybody who should be involved in your situation prior to making any decisions based on what we talk about today. We are going to discuss a handful of individual securities today, just really talking about sort of what's happened in the chip maker space. We, our clients, may or may not maintain positions in those securities. So again, don't make any irreversible decisions based on what we talk about. And we are a registered investment advisor regulated by Securities and Exchange. So if any of that doesn't make sense and you have questions, feel free to reach out to us and we can translate for you. All right. So diving in, we've had a lot that's happened here in the last, what day is it? The 28th of January is we're
Yep.
recording this. So in the last 8 days, there's been quite a bit that's come out, particularly from the brand new Trump administration in terms of their economic policy. And a lot of that has come through in the form of executive actions. So Tim, do you want to kind of walk us through what's already come out and what are we seeing so far?
Yeah, it's quite head spinning. I know the Trump administration promised to hit the ground running, and that's certainly been the case in the first few days of his presidency. So we've seen a flurry of executive actions to date, and this changes minute by minute. Trump has signed 54 executive actions on topics like federal government, so 19 actions on federal government. And you can see this in the chart to the right side of the page. Immigration, we've got 8 actions. Climate and energy, we've got 6 actions. Economy, 6 actions. National security, 4. Foreign policy, we've got 3. And then we've got many, many others. And many, I would imagine, are certain to come in the next few days and weeks. Heading into the election, and since the election in November, areas that we've been primarily concerned about for investors are related to trade policy and tax policy. So are we going to see tariffs with some of our trade partners or with other trade partners across the globe? And are we going to see changes in tax policy, namely corporate tax cuts? Are we going to be seeing those? So as it relates to tax policy, we haven't seen too much announced to date. Nothing firm. I'm sure something. I know that's a priority for the Trump administration. I know they talked a bit about that. I imagine we're going to be seeing some news as it relates to that, whether it's a day, a week, a month. That's going to be coming. But we did start to see an initial action as it relates to trade policy and the country of Colombia. So on Sunday, we had what I would consider just kind of a mini trade war. I don't know if you can really call it that, but this was a very, very fast moving situation where the Trump administration wanted to see some concessions as it relates to immigration policy and deportations and so forth. And in order to, I would call it a stick versus a carrot kind of proposition, they threatened tariffs on Colombia. And we saw a quick reaction from the Colombian president stating, well, we're going to implement our own tariffs on goods exported from the United States into Colombia. And, oh my gosh, I'm reading this and I'm thinking, hey, this could escalate, and this could be our first glimpse into a trade situation, a potential trade war between a trade partner. It was quickly resolved, and concessions were made. But it kind of gave us a glimpse into what I was really expecting from the Trump administration as it relates to trade policy, as it relates to tariffs. I think, one of President Trump's main initiatives is related to immigration and deportation, and that's been a big focus in the early days of his presidency. And in order to get concessions related to immigration, deportations, and so forth from Mexico, Canada, and other countries across the globe, the threat of tariffs exists and can, like I said before, can be a carrot versus a stick kind of process. I would expect in some of these situations we could see, quick concessions like we saw with Colombia, and everybody can move on as if nothing happened. Or we could see, tensions build and tariffs stick a little bit, and that's kind of what we're worried about. It is potential issues that cause supply chain disruptions, or tariffs that are implemented and stick and could potentially raise costs for consumers. And obviously, inflation's been a big concern of ours over the last few years. So there are some risks there, but I think it was interesting just to get a glimpse into our first foray into tariffs and how the Trump administration intends to use them in getting policy concessions from trade partners. Jared, anything you want to add onto any of that there before we move on?
I think it's just interesting that we're sort of looking at a presidency and an administration that is likely to commingle economic and non-economic issues, particularly when it comes to foreign policy. And so I think this is a perfect example where essentially Colombia was refusing to accept its citizens who had been deported from the US for being here undocumented or illegally, or I think the official term has been mandated to go back to illegal. We know that term carries a lot of weight, so we're just trying to describe things accurately here. Non-citizens who had been deported back to Colombia, Colombia was saying, we're not going to accept them. And the US says, well, fine, we're going to impose tariffs on your goods and services. And that was the stick that you're talking about. And so I think we've seen some of those in at least initial discussions with Eurozone countries as well about needing to meet the mandated minimums on percent of GDP spending on defense to remain a part of NATO. And the Trump administration pushing harder on European countries, saying you need to contribute more to your own national defense. You're sort of free riding on US defense spending. So a lot of those are foreign policy goals and objectives that are likely to be tied in with economic issues. So it's just going to be something that will be a little bit different than what we've seen from prior administrations. And it'll be something that we continue to monitor and watch. And so please tune into these episodes, read Tim's blogs as they come out every month, where he does a deep dive on all of this data and information, because it is going to be different than what we've seen out of the last few administrations.
Yep. Never a dull day, I can imagine, in the days and weeks ahead. And I'm excited to communicate all that and everything we've learned with our investors. So moving on, we had a couple other announcements as it relates to investments in the United States. So we saw an announcement related to Project Stargate. So that's essentially a $500 billion private sector commitment to build AI infrastructure in the United States. So when you think infrastructure, we think power supplies, we think data centers and things like that, in order to allow the U.S. to build out the AI to its full capabilities. And participants who have committed capital to this include OpenAI, Oracle, SoftBank, and many more who have committed capital there as well. Jared, anything else you want to share on that particular one, or that you're aware of that would be important for everybody to be aware of?
I don't think so. We
Yeah,
will definitely talk more about that as we get into our upcoming slide where we talk
yeah,
about AI and chip makers in general. At this point, it's a commitment. So that's
yeah,
essentially a public declaration that says, "Here's a project we're going to do," and the players are stepping up and saying, "Yep, we don't have the money today, but we will have it in the future, and we're committing this much." So we'll see what ends up coming of that. I think it's just another interesting development to watch.
yeah, yeah. They're very loose commitments. And the same is the case with the last bullet point here, the Saudi commitment. So Saudi Arabia's Crown Prince Mohammed bin Salman announced that Saudi Arabia would invest 600 billion in the U.S. over the next 4 years. What those investments look like are really difficult to envision. There's been very little reported essentially on what that would look like specifically, whether it's the Saudi commitment or Project Stargate. They do make good photo ops and things like that, but it is important because these are commitments that could help boost key areas of our economy, particularly as it relates to the AI investment, as that's been a key focus. And we saw markets react positively to that stated investment when it was made about a week ago. And then that leads us to the next slide, where some of that exuberance has been reversed a little bit. So,
Yeah.
yeah,
Yeah.
a
So
bad
just
day for
to
the AI trade. Let's just put it that way, right, Jared?
Yes, yeah. This is fascinating, and it's one of the few times because we do this on a monthly cadence where we really do get to report on something that's kind of breaking news. So this all really broke on Sunday of this past week, was reflected in markets on Monday the 27th. Tim, talk us through what happened here.
Yeah, it was quite the shock, to see some of these numbers for some big hitter corporations in the United States. Yeah, Monday the 27th, we saw a collapse, particularly in the semiconductor sector, with stocks like Nvidia down 17%, Broadcom down 17%, Taiwan Semiconductor down 14%, Micron Technologies down 12%, and Advanced Micro Devices down 7%. Those are big moves, trillions of dollars, not just across semiconductors, but across more of the technology sector in general, and those who have made big commitments to the AI trade. It was a rough day, and news is coming out as fast and furious. We still don't know all of the details as it relates to this, so I want to be very clear. It's still somewhat muddled, but we're learning a lot, and we wanted to share what we know, at least to this point. So what happened? We saw a new entrant, AI entrant, company called DeepSeek, essentially made claims that shook the tech world. So who is DeepSeek? DeepSeek is a Chinese AI company with an app that was released in early January, so around January 10th, that rivals OpenAI's ChatGPT. OpenAI's ChatGPT is largely considered the best AI chatbot language learning model around. It's essentially considered the best of the best. But we're seeing, and based on reports from DeepSeek, that their capabilities, DeepSeek's AI bots capabilities rival that of ChatGPT. And you can see this in the chart to the top right that shows essentially accuracy scores as it relates to certain capabilities around math, coding, science, language learning, whether it's English or multi-language learning capabilities, where we've got DeepSeek's capabilities and accuracy scores shown in the blue bars, whereas OpenAI is in the black. So you can see very comparable, and that alone was very surprising. And then DeepSeek claimed to have achieved these staggering results using lower cost chips and less data than the U.S. counterparts like OpenAI. So DeepSeek claimed to train its AI model for only $6 million, essentially in computing power and so forth, versus $100 million essentially claimed that ChatGPT utilizes to train their AI model. Less computing power equates to less energy usage. If you're using essentially what they would consider, or some would consider, lower quality chips, that means you could do a lot more with less. And that really hurts a company like Nvidia, who is creating the best and brightest in AI chips. And maybe this causes some competitors to say, hey, do we need all these NVIDIA chips that are the fastest of the fastest of the fastest? If DeepSeek can do this, with baling wire, shoestrings, and duct tape, and so forth. So it's also interesting because DeepSeek is an open source platform that could potentially lower the barrier for entry for AI innovation in general. So we've seen a lot of the largest companies, the Magnificent Seven companies in the United States, benefiting from this AI trade essentially to date. So you look at the chart to the top or the bottom right, where it shows tech stocks have soared on Wall Street's expectations for AI profits. So what this chart is showing is essentially the returns of the Nasdaq and the tech-heavy Nasdaq since essentially the onset of the COVID-19 pandemic. And you see certain inflection points there. So we see a steep rise up until 2022. In January 22, we started to see the sell-off as inflation really started to cause damage to the U.S. economy. Then around November of 2022, ChatGPT was rolled out by OpenAI, and that was really eye-opening for everybody. That kind of changed the game and got a lot of excitement around artificial intelligence and the capabilities there. Then a few months later, we saw Google unveiled their AI called Bard AI, which has since been named Gemini, and it's been quite the ride up ever since, and to where we are today. And essentially, this is really the first major disruption we've seen from that upward trend of where NVIDIA chips rule the world, and AI and these major corporations are going to own all of the profitability as it relates to this, and they're going to be the key drivers of all of this. Well, if DeepSeek can do this for $6 million, why can't other startups around the world do that? Or existing companies say, hey, we can build our own models in AI, and we could do it for much cheaper than Meta's currently doing it right now. Google's currently doing it right now. So a lot of these companies' valuations are built on the forward-looking thesis that AI is going to rule the world, and the Metas, the Googles, the OpenAIs, the Amazons, the Teslas, and so forth are going to be major players there. And this shakes that narrative a little bit. So that's what's causing some angst in the semiconductor space, and causing some angst in just the tech space in general. And we even saw power companies, players in nuclear power and generation and stuff like that, sell off a little bit yesterday because, hey, if we don't need as much power, then their services aren't going to be as widely utilized or needed moving forward. So just an very interesting day. We're still learning a lot. A lot of these claims have, I think they're going to come under scrutiny, whether or not they're really using cheaper and less efficient chips, whether or not these claims can be substantiated. Let's just say they haven't been peer reviewed, but we'll see. I think they're going to get a lot of scrutiny now, and we'll see what happens. So been a fascinating day and a lot still to learn, but we wanted to bring you up to speed to where we are, at least at this point. And Jared, anything else you want to add? It's been a fascinating 24 hours.
Yeah, I think it's just from an investing perspective, an example of why we still advocate for diversification inside portfolios. So while the S&P 500 has largely been driven by these Magnificent Seven tech stocks over the last year, 18 months, that's been great. But when you get a bad day, or what could potentially turn into bad days or bad weeks, that also, that knife cuts both ways. So when we look at things like, well, why do we continue to own mid-cap stocks, small-cap stocks, international, private credit, fixed income, short-term cash equivalents, all of these different things, they all have their role to play inside an investment portfolio, so that you're going to benefit from the good stuff when it happens and be buffered against the bad stuff when it happens. So I think this is just a great example of why you don't have 100% of your portfolio in NVIDIA stock. Because it really can take you for a ride as news comes out, particularly in an emerging area of technology where there are new discoveries and new use cases and new companies that are coming to market every day. And I think, in the short term, it could be if this ends up being proved out to be true, that they could do it for, a tenth of what it costs previously, that's a great thing for humanity generally.
Yeah.
Maybe it's not going to be as costly and as power intensive to utilize some of these language learning models. Or it could come out that, hey, they've actually gotten around some of the CHIPS Act essentially embargoes on distribution of certain
Yeah.
types of chips, and they've been running a data center with 50,000 NVIDIA chips, and that was the only way to do this, and they just couldn't come out and say it because they're not legally allowed to. So maybe NVIDIA shoots back up 30% on a day if that ever comes out. Who knows?
They
That's
just
the
peeled the NVIDIA sticker off, right, Jared? They just peeled the NVIDIA sticker off all their chips and yeah,
Yeah. Yeah, no,
it's
it's white
generic.
label, I promise.
Yeah.
Yeah, so we just don't know. But I do think for investors, this is why you stay diversified. This is why you invest over longer time horizons, and you don't chase the new hot thing because you can get burned going the other way.
And markets can be very reactionary. I mean, there's little that can justify a company selling off 17% in a day. I
Yeah,
mean, it's just crazy. And uh, you know, cooler heads often prevail, and I think that's going to be the case here. I think NVIDIA is still an incredible company, and they have an incredible future. It's a tough day for them, but yeah, you don't sell based on these types of headlines. You digest them, think about them, and then see what happens as you learn more. But for people completely exiting NVIDIA positions based on this one outcome, you know, maybe it pays off for them, but it probably doesn't. So markets can just be very reactionary to headlines, and that's something to be mindful of as well.
yep, absolutely. All right. Welcome back to the show that never ends. We're going to talk about inflation again and what's happened recently, what we're paying attention to, and some of the key factors. So don't tune out. I promise this is important information because inflation is still the key driver on the investing side right now. Tim, what are we looking at in January of this year?
Yeah, it's unfortunate to keep talking about inflation, but it's really an important story because it relates to Fed policy and essentially interest rates. And investors have been trying to navigate interest rate uncertainty for the last 2+ years, right? Um, it's been very damaging for bond markets in particular, as we've seen treasury rates fluctuate over time as investors are trying to guess where the treasuries are going to end. So we've seen the 10-year US Treasury fluctuate from, let's call it 3.6%, all the way up to 4.8%. And those moves upward can have a damaging impact on fixed income allocations because as interest rates go up, bond prices come down, and vice versa. So, and we've just over the last, even over the last 6 months, we've seen great fluctuations where interest rates move up, they move down, they move up, they move down, and it can make for a very, very frustrating ride. But hopefully we can get more clarity around this in the year ahead, and I think we'll start to see a shift in Fed narrative, and we'll talk about that in a little bit. But first, we'll talk about where we are with inflation. I always, with our team internally, I've been using the quote: "The last 5 pounds are always the hardest to lose." Anybody that's been on a diet, they know that. The first 10 pounds always kind of just seem to wash off pretty easily, and then most people tend to plateau at a certain point and say, I just can't lose that last 5, 4, 3, 2 pounds. And it can be very frustrating. I feel like that's where we are with inflation. And you look at the charts at the top right, and you can really see that where it was really easy shedding off inflation from where we were in, let's call it June of 2022, where it peaked over 9%. And then we've seen a quick descent down to better rates, better inflation inflation numbers, excuse me. But then we've seen it plateau, right? We've seen, you can see that core inflation in that orangish yellow line has really moved sideways over the last few months, particularly since around, let's call it April of 2024. And what's been frustrating is inflation, or excuse me, as it relates to inflation, shelter and the shelter index continues to be a key contributor to the all items increase on a year-over-year basis. And you can see that's the chart to the bottom right, where we see CPI inflation in red, and then we see essentially the shelter index, the shelter contributor to inflation at 4.4%, and shelter is essentially 33% of CPI. So we're not going to get down to that 2% target without seeing even more considerable progress as it relates to shelter. And that's just been something we've been talking about forever, it seems like, right? It's been very frustrating. I think the Fed's frustrated. I think the Fed is probably, if you ask them privately, the FOMC would be very surprised that higher interest rates and higher mortgage rates have not stopped the ascension of the shelter index, of home prices, and so forth. We've seen a slowing down in year-over-year growth, but not quite the progress that the Fed has been hoping for. So what are we going to get in 2025? What do we think? Well, the Fed is actually meeting right now. They're meeting today as we talk right now, and their meeting concludes tomorrow, so Wednesday the 29th, January 29th. We expect the Fed to keep interest rates at the same level, so no interest rate cuts for the foreseeable future. We expect potentially the next rate cut to come around summertime, so maybe around the June 18th meeting, we might get a 25 basis point rate cut. There are, and I'll be really curious to see the commentary from Jerome Powell after this next meeting to see if he starts to shift the narrative a little bit in the direction that I'm imagining he wants to go. Because really, there are only so many levers that the Fed can pull. And like I said, higher interest rates have not had the impact on the housing market, namely, that the Fed had envisioned. So I think Powell is going to put more and more of the onus and pressure on the federal government to impact shelter costs by expanding supply. So right now, the only thing that the Fed can really do is hinder demand through higher interest rates. Hey, get more people out of the home hunt because they can't afford it because interest rates are too high and mortgages are too expensive. That's not really working as intended. I'm sure it's had some effect, but not the effect that they're looking for. So they need to come at this at two fronts. So they need we're going to have the federal government hopefully increasing supply, and then we have potentially the Fed hindering demand, and those two things at once could potentially lower housing costs over the next 6, 12, 18 months if we really make considerable progress there. So, what does that supply look like? Increasing supply look like? That could be affordable housing initiatives, that could be home buyer credits, it could be builder incentives, zoning reform could be a big one. Reducing red tape, public-private partnerships, supporting innovation in manufacturing, whether that's prefab or modular housing. It could come in any way, shape, or form. But I think you're going to see a lot more pressure from Powell, at least overtly, where in his commentary he'll be talking more about the housing supply side than he is about hindering demand. And whether or not that works, we'll see with the new Trump administration and the new Congress. But I think that's where the Fed is wanting to go. And I imagine maybe not in this meeting, but in future meetings, we'll see more and more of the dialogue shift in that direction. And then I think we'll start to hear more of the conversation shift to, how close is close enough? So if you think about it, that Fed's 2% target is somewhat arbitrary. If you look at CPI, headline and core CPI averages since 1985, headline and core CPI have averaged roughly 2.8% in the United States. That's roughly where we are right now. Core is a little bit higher, but we're pretty close to that number. And like I said, that 2% is somewhat arbitrary. That was first made public only back in 2012. That seems like it's been a tenet of the Fed since its inception back in 1913. That's not really the case. This is something that was announced by the Fed in 2012. They thought it was important to publicly state what their inflation target was, and they thought that would be good for the public and set expectations in the mind of the public to keep inflation well anchored moving into the future. What I think that's kind of done in this case has painted them to a little bit of a corner. You'll note that they don't have a target for the unemployment rate. They have a dual mandate. Mm-hmm. The second part of their dual mandate is full employment. they don't state what full employment is. They don't say that's an unemployment rate of 4%, 4.2%, 4.5%, 3.8%. If they had, we'd probably be holding their feet to the fire a little bit more about that target. Like, say, if they said it was 4%, we move up to 4.1, 4.2%. I think there would be a lot more questions from the public and a lot less wiggle room for them to navigate the unemployment rate. And I think they have less wiggle room as it relates to inflation because they've stated a target. So will they start to shift that narrative and say, well, historically, inflation since 1985 has been 2.8%, and we're kind of at that level, and let's say we get to 2.5%. Is that enough? Will they say, hey, that's close enough to 2%? I think we can start to ease monetary policy, ease restrictions, lower rates a little bit. We'll see. I think that's a direction that it could go, because I don't know how feasible that 2% target really is, at least in the short order. Maybe in 3 years, yes. I don't know if it's 6, 12 months, if that's absolutely feasible. We can move in that direction, and at some point, I don't know if Powell rolls out the mission accomplished banner if they're still at 2.4%, but that's a possibility. So just something to think about as we're moving ahead. And at that point, we could potentially see monetary policy easing quite a bit more and see rates come down to more normalized rates, which is what I think investors are really hoping for. Just more of a neutral rate that isn't restrictive and that can open up more doors for the rest of the economy. Small cap companies could be less onerous on fixed income, navigating interest rate uncertainty and all that. So I know that's a lot. I'll cut it there. But Jared, anything else you wanted to add to that perspective?
I think it's fascinating if you just change the context and say inflation is now at its 40-year average. That feels a lot different than saying inflation is failing to fall back to its arbitrarily assigned below historical average number. So it'll just be interesting. I agree with you. I think the Fed is essentially saying we're back to a normal economy, right? The cost of capital is kind of in a normal historical range. It's not expansionary. It's not overly constrained. We're at good levels of unemployment as far as their mandate is considered. It's kind of like, what else do we have to do here? Other than walking back their declaration that 2% is the correct number, as opposed to before we started this call, we were saying, why wouldn't they just assign a range and say it's somewhere between 1% and 3% over an extended time period we think is generally okay, right? You could say something like that, and you're effectively saying the same thing, but just with a little bit more realism behind it. I don't recall too much angst between 2011 and 2021 when we had inflation around 1% a year, right? There wasn't a massive push to, we got to get inflation back up to the 2% target. So it'll just be interesting to see where we go from here. I think it was probably September last year where we essentially said the soft landing has been achieved, right? That was the conversation coming out of COVID. How do you make sure that you don't crush the economy, but you bring inflation under control and have employment numbers look good? Well, they did it, and we've been there for a while now. So I think I'm right there with you. Some of this needs to be fiscal policy. And that needs to originate from Congress. Monetary policy comes from the Fed, and that's interest rates and things like that. But as you said, those are very limited tool sets. And, this is stuff that needs to happen at the local government level, looking at zoning and use guidelines, permitting processes, some of those things that constrain the housing supply at the local level, all the way up to the federal level, looking at, tax code incentives, mortgage guidelines, different things like that may be able to influence the supply side. So it'll be fascinating to see what happens, but I think we probably are where we are.
Yeah, I agree.
All right. Well, we talked a lot. We had a lot to look at, but we had fewer slides today. So I'm going to move to just our Q&A slide. Tim, any thoughts as we wrap up for today?
No, I know that's a lot. And I do want to let you know, for everybody watching, you will get a copy of this handout, PDF, because I know this is text heavy on some of these slides. So I don't know if we mentioned it earlier, but you will get a copy of that. this presentation, so you can review the charts on your own and on your own time. If we move through things a little bit quickly, you can and read the text as context as a reminder of what we discussed today. But yeah, a lot of moving parts, a lot going on from the Trump administration to DeepSeek, and this is why I got into investing, because it's just fascinating from a day-to-day basis. And this past week past month, to be honest, has been no different. So we'll obviously keep you all posted as new issues emerge, and we look forward to doing this again in a month. So we'll see you then.
Yeah, and any questions that come out of this, feel free to reach out to Tim and I directly. Reach out to your Destiny Capital team. We love talking about all of this and helping translate it to you and your family and your lives. So please don't hesitate to reach out if we can help any further. And thanks so much for your time today. We know how valuable it is and appreciate you taking some time with us. So we'll see you again soon.
All right, thanks everybody.